Welcome back. You're still watching Markets at Noon, and now joining with us is Mr. Pramod Amte, Head of Institutional Equities Research and Credit Capital. Pramod, good afternoon. Thank you for giving your time to ET Now. It's a pleasure talking to you this afternoon. Looking at the current picture of the market, we're not negating the positives. Yes, the GST rate rationalization was a big move. And the markets did cheer and enjoy that also to start with. But it's not seeing the absolute comeback as it should. And the reason behind it, one such or a concern at least, is the FIs selling. Now, what has happened to the FIs? Why not making the comeback? Don't you think it's an opportunity loss at present and not entering a market like India?
No, I think government actions are definitely welcome. This is in terms of quantum similar to what the income tax reduction, which we saw in the budget, in terms of absolute. And this is across the segments, right? Across the consumers, not just the taxpayers. Having said that, the relative position of FI and DI has been playing out for the entire of this year, hasn't changed. Especially the reason, one of the fundamental reason is the way the earnings cycles have been. If you look at post the result season, Indian markets are still seeing earnings cut. Anywhere in the region of around 1 to 3%. Versus contrary to that, some of the global markets, including the development markets, are surprising positively on earnings, and analysts are upgrading earnings. So in a context where you are mean level valuation on PE, on a relative basis, you are still at +1 standard deviation to the global or the Asia MSCI. So you need earnings to come through. The GST cut gives that hope that it should come through. I think they would like to wait and see as they come through, because we have been almost on a 1 year of earnings cut or reduction process. Hopefully we should bottom out this quarter and come back with a very strong bounce in the festival, and which I think should be a combination for the long only FIs to come back.
Right, you mentioned about earnings is something which market is watching out. Now, three important data points have happened as far as the macro is concerned. You have got an upgrade. Q1 GDP came at 7.8%, and now GST push by government. So macros are saying all is well, but I guess market is not responding. Do you think that we will have to wait for concrete data till Q3 for that?
As you indicated, some of these points are macro and also medium-term oriented, right? So especially the government action is definitely medium-term oriented. Similarly, the rating upgrade, which should reduce the cost of borrowing for corporates on a medium-term basis. But the high frequency, some of the actions which have come through are from the government, are also the fact that a reflection on the high frequency data being very weak. Okay, so there is a contradiction which is happening on high frequency versus the quarterly data which is coming out, and very well recognized by the policy action by the government, which, as I indicated, should reflect in the earnings as we go forward. And having said that, we have improved substantially from the lows of March to where we are. But on a relative basis, India is on the lower quartile of the 50 countries returns if you look at. So we need to pull up and deliver on the earnings where the valuations are fair to give a comfort that we will not slip further.
Okay. Pramod, the global challenges might prevail, but then all eyes on the domestic front are on the festive season. And having said so, how should one strategize their portfolio for, let's say, 6 to 8 months? Because that's where the festive season will stay. One should favor the large caps, or should also consider the broader markets. And yes, any high conviction ideas if you would want to share with us.
So our index target is somewhere around 3-4% upside from the current level for March exit. We have been saying this for some time, that the market will remain in the consolidation phase, which continues to play out. We continue to prefer large caps over mid and small caps. In terms of our what we have changed in the recent times is individual sector-wise we have found some valuation comforts in IT. We have done some one or two stocks where the relative valuations are comfortable, like Wipro and LTTS. Similarly, we have upgraded HUL to add after a long period. We are taking those actions. In terms of high conviction stocks, we in this month for September, we have exited Ethos. That's the only exit which we have. Otherwise, we have maintained all the remaining 20 names where we are playing out for Festival, the direct beneficiary of the GST cut through auto names like Bajaj, Maruti, proxy names for example, financiers, Bajaj Finance, Shriram Transport Finance, or to that extent even TCPL packaging, which will be playing out on the indirect benefits on the same. So that's how we are positioned on the high conviction stocks.
Right. You mentioned about IT. I want to get your view on the consumption stocks as well because they have been in rise ever since GST announcement have been made. Which are the pockets you think one should still pencil in?
I think the broader thought process is clearly the high demand elasticity segments, where the price makes a substantial difference to the consumer to come back in a big momentum. So I think that's clearly visible in the discretionary space. And within that, the lower ticket items on the discretionary, which starts all the way from on the listed space for two-wheelers, where the bigger comfort, along with the macros being favorable for rains and the rural, that gives them edge. And the other consumer names, including where ACs have been hammered post the result season. So those are some of the consumer names where we will be relatively better placed to position.
Pramod, two spaces where I want a brief view. One is the insurance space and another is the Syngood. Talking about the latest announcements, an absolute exemption on the individual health and life insurance. Yes, one thing, it was a good positive move, but then is there a caveat because of which the insurance players are not performing at present? And also, highest tax rate of 40% on the Syngoods. Now, how do you see these segments performing?
I wouldn't be able to comment on insurance, which we don't have as a sub-segment coverage. We have the entire BFSI. So I'll avoid that question. Coming to the Syngoods, broadly, I think that was on the expected lines that it will be coming through. I think in that extent, some corrections have been happening. But I think this segment has been punished or has been the milking cow for the government for a long. I don't think there is any change per se happening there. It might take a couple of months or quarters for this to be absorbed into the pricing of these products and the demand fluctuations. But structurally, we feel that the relative basis, some of the companies still extend a value, and that's how we would be more selective in that sub-segment. One of the reasons why we were also worried about some of the luxury goods like Ethos, which we exited, were expecting some harder actions by the government. But I think they have been prudent in selecting some of the names versus the entire pack.
Mr. Amte, thank you so much for joining with your views.
Thanks.